Hi, Kanchan. Good to meet you in this forum. We are going to spend some time perhaps deliberating about private credit fund and the sector as such, particularly in Indian's context. BPEA is, of course, making great strides in the sector segment from a global perspective. You've also made some good deals in India. To begin with, perhaps I'd like you to share a bit of introduction about private credit fund for our audience. Though it's an established asset class, we might start from the basics for the benefit of a lot of our viewers and audience, if you wouldn't mind, as and from there on, we can take it further.
Sure. Good to be here again, Jay. Yeah, I think, just very simply, we're all used to thinking about debt largely given by banks, right? And then we have the more public markets, which are the debt capital markets, right? These are the sort of two main asset classes everybody associates with when you think of credit. I think over the last decade or so, there has been phenomenal growth in an additional source of capital that also provides debt, across various segments, all the way from microfinance, SME, mid-market to larger corporates. And that's basically, so non-bank, non-public market funds, is essentially what is private credit. And the typical source of capital for this is, from large institutional family investors, insurance companies, pension funds, endowments, and really family offices. It has proved to be a pretty resilient asset class. Has generated, pretty strong returns. It's now the third largest asset class amongst private markets. And almost $1 trillion of AUM globally. A lot of it really comes from US and Europe, but the asset class has also been developing quite fast in Asia. And in India, it's really amazing how well the asset class has grown in the last few years.
Right. To be a little more specific and perhaps academically correct about this, does private credit have all the features of private equity, except for the fact that equity is not there, it's a debt? Otherwise,
yes, you could think of it like that. That essentially it is a bilateral sort of private transaction between the investee company and the investor. The investor usually being a fund dedicated to invest, in the form of debt. And yes, the investment is in the form of debt issued by the company. It could be hybrid, it could be senior secured, it can be all places in the capital structure. But yes, in that sense, there is a strong similarity with private equity.
The very nature of private credit puts this in the higher bracket of risk return spectrum. But when you compare this with PE, in view of IRR, yield, and risk, from an investor point of view, as well as from a borrower point of view, can you elaborate a little further and see how would one weigh these options?
So actually, private credit covers, a whole risk profile. I know the narrative, all of us think of private credit as being more risky by default, but actually it covers the entire, risk profile. If you think of, risk-free rate or whatever, wherever it was, obviously it's on the rise now, but if you think of sort of low single digits all the way up to 20%, private credit can cover the entire range from 5% to 20%, depending on the specific strategy, right? So you've got private credit that does more senior secured lending, and it's in sort of, high single digit kind of returns, or low single digit to high single digit returns. And I'm saying in dollar terms, it won't be very different for India as well. Then you've got the more mezzanine, mid, sort of part in the capital structure, which may be low double digits. And then you've obviously got the distressed end of the spectrum, which is also private credit, right? Because, and that tends to sort of get to the 20%. So it covers the entire range of risk and return. And therefore, in that sense, also, it's a very interesting asset class for investors, because you can pick the point you want to be in and then say, okay, for this point, am I getting the right return and what's driving the return? And, therefore it becomes a very interesting asset class. And I think a mainstream asset class in most sophisticated investor portfolios now.
What is BPEA's view of India as a market on mobilizing as well as deploying funds? How are you viewing it? Which are the subsegments that you would have on top of your mind? And from a investor standpoint, you've talked about family offices. India is known for some of the best family offices, not offices per se, but at least some of the wealthiest families that we have. So are you finding traction enough? Are we finding enough source of funds in India? Obviously, deployment, there is a lot of opportunities. We'd like to hear the subsegments that you would want to focus on deployment as well. But perhaps to start with, on the source of funds, is India's traction in India is good enough? Is it at par with expectations?
Yeah, so in fact, if you just look at, I mean, what we, just to sort of clarify, what we focus on is performing credit, right? We invest in established companies that we believe are high growth, companies, good credit risk, good corporate, and then we provide more bespoke capital for growth. That's our sort of subsegment within the private credit asset class. We have, recently last year, we closed a pretty large fund, one of the largest funds actually in Asia when it comes to single country performing credit funds. And a third of our capital is raised from India, right? So, and it's actually from institutions in India. It's ultra high net worth, it's family offices, it's Indian banks, Indian financial institutions. So I think private credit as an asset class is in that sense well understood. It's sort of quite mainstream for a lot of the family offices. And all the family offices who go through allocations or who look at it on investment by investment basis have completely recognized that it's an asset class where you need a specialized, dedicated fund manager that can create the right portfolio construction, right, and the right sort of combination of risk and return for it to then give a resilient return profile to investors. So whether it's at par with international markets, I think it'll take some time for us to get there. The market has been a sort of a 10-15-year market in the US, but very much on the way.
Okay, excellent. In terms of the deployment opportunities, you said you're actually looking at performing assets in that sense, but India's unique startup ecosystem and the sheer size and the variability of it, like in the the number of options that you have out there, right, from e-commerce to tech to services to agro tech, and then we have the mid segment, the not so much talked about them, but that's where the huge unmet credit gap is there.
Yeah.
How is BPEA looking at these opportunities? Do you have some view that you can share in terms of where will you prioritize? How will you go about meeting these demands, and where will you bet?
Let me answer this in two levels. One is just the structure of the market, and then where we focus on. So and it's not just BPEA. I think the number of international fund managers and investors are now focusing on India as an opportunity, is phenomenal.
Yeah.
I think firstly, and you're right, there's the whole venture ecosystem, venture debt, venture ecosystem. There is the entire established companies and their needs for credit and capital. And then there is the more special opportunities, special sets or distressed end of the spectrum, right? Very simplistically. But I think an important thing to sort of talk about when we look at the market opportunity is just think of the narrative a little bit. I think the narrative over the last few years has a little bit inefficiencies in the banking system or inadequacies in the banking system that's driving, the need for private credit. And actually, that's not the case. I think banking system in its own right, will always be a mainstream provider of capital, and it's the case. So even so in India, it's we're $1.5 trillion of bank loans outstanding, so it's sizable by any standards. But I think what has happened is that if you look at the fact that banks are predominantly intermediating depositor money, right? And for the stability of financial markets, the regulation on the banking sector, rightfully so, has increased in the last 10 years. Banks are also becoming larger and larger institutions, right? I mean, our largest banks are now a couple of $100 billion in terms of assets. Yeah. At that size, and given that you're sort of, looking at a certain risk profile, you have centralized risk policies and risk frameworks, whereas the credit disbursement is a distributed model. So by definition, the lending model is very much wholesale, and it needs to stick to a certain risk framework that the bank has adopted. And I think, and therefore, in some ways, banks are really, very well suited to meet all of the working capital needs. And in fact, are probably the most efficient, providers of capital in that segment, or even the sort of more vanilla corporate requirements or term loan requirements. Now, on the other side, if you look at corporate sectors, they've become more dynamic. The needs are more dynamic. There are requirements for acquisition. There are requirements that don't necessarily result in hard asset creation, but is necessary for earnings growth, right? Be it initiatives like digitalization or adopting new technologies, or simply just looking at service sectors, right? There we have a whole new business models in traditional industries, which are just asset light, right? Logistics is one example. So I think if you put the two together, you can see that there is a growing need for a source of capital, which is providing debt, which is allowing the promoter to leverage their equity, but it's actually meeting very customized and bespoke needs of the borrower. And in some ways, that's where private credit can play a tremendous role. So when you think of the market opportunity, if you look at the US markets, more than 50% is actually non-bank, right? Europe is at the same level.
Yeah.
Let's look at Asia and India, 70% or 60% is actually bank credit.
Thanks, yeah.
You combine that with the fact that we are about 60% debt over GDP, you know there is a lot of scope, within our corporate sector to take on incremental debt, responsibility. Banks have their own sort of targets to meet in terms of meeting a lot of that credit requirement. But I think there is a sizable demand for credit for something that's a little bit more customized and a little bit more tailored. And that's where private credit funds, can come in and play a big role. Coming to the second part, I think for us, where we've seen a tremendous opportunity is the mid-market space, right? And I think when we done our own research, at the top, mid-market contributes about, say, 40%, right? Amongst the organized sector, about 40% to output. And that number is not very different, globally, even in the developed world. But I think with India, if you look at it on a sector by sector basis, 3 out of 4 sectors, mid-market is actually the dominant contributor, to the output of any sector. And interestingly, if you see within that sector, if you look at the top quartile of companies, for instance, they would then occupy almost 40-50% of the sector output, right? So you have a massive mid-market sector.
Yeah.
It's I think a great sort of private entrepreneurship story in India.
Yeah.
Strong growth prospects, just where things are, the reforms and everything that's happening. And in some ways, a lot of these mid-market companies that have been around for 25 years are best placed to benefit from the growth that's happening, right? Across various sectors. And I think that's where the need for capital is the most tremendous, right? So we actually find companies that we think are well run, are best placed to benefit from the growth, and then have a strong and a clean repayment track record, and then look at going in and providing a customized solution that would help them to go from A to B. And what's interesting for these companies is the capital we provide is non-dilutive. So while it comes at a slightly higher cost, it actually meets exactly the needs of the business, and it allows them to get to that next level of growth.
Excellent. Does it also combine a bit of expertise, like how perhaps the transformative capabilities PE brings to the board? You don't just provide capital, but you also help a mid-segment player or a MSME to have the next level of growth, or perhaps become more profitable and all that. To what extent private credit fund does get into lending the next supporting hand beyond just funding, or is it exactly same as bank? Or
no, so I think it probably sits somewhere in between. So what we've seen with a number of our companies is that we put into place certain monitoring systems, or we put into place certain different ways of looking at the business. For instance, if you're looking at a particular EPC company that's providing EPC into the road sector, we think of the risk profile of the underlying projects very differently in terms of whether it's an NHAI project or if it's, whichever the agency, it's a state project. So some of our conditions will also be operational covenants, which would talk about, the portfolio of contracts the company is executing, and how we view those, and how we, want the company to stick to a certain profile, right? We have provided sometimes on-lending facilities to other financial institutions, smaller, institutions that provide microfinance loans. Our requirements in terms of monitoring on the loans, so static portfolio analysis, looking at seasoning, looking at sort of loss rates and loss curves, is something that, our investee companies have come back and said, actually, we've now incorporated this as a regular, in our this thing. We have, IFC Washington is an investor in our fund. So we've, adopted the IFC performance standards. So every company goes through a thorough ESG analysis and has an ESAP plan to adhere to. So a lot of what we do also allows the companies, to get further on their ESG journey. There's always commercial pressures, but I think companies also realize that there are long-term benefits to having some of these things in place. I think over the years, we've effectively become like a go-to for a lot of these companies. They obviously have their banking relationships and they're very important for them. But every time there is a more bespoke need for capital, we become a go-to sort of, firm to sort of discuss and brainstorm, what could be the funding solution. Sometimes it's to do with equipment leasing. Sometimes it's to do with, increasing revenues from a certain type of customers. So yes, that relationship over a period of time becomes bigger and bigger than just a single financing relationship. And we've seen this with a number of our investee companies that, from where they were, we've seen their revenues grow almost 3 to 4 times, their valuations grow 3 to 4 or 5 times over these years through just having the ability to get that sort of bespoke capital in a timely fashion and, allow them to implement the changes that they wanted to in their business.
Excellent. If you were to look at India's non-banking segment in particular, there's a lot of fund requirement that is being met from the retail NCD market. There is retail NCD market which are market linked and which are basically privately placed as well without any linkage to the market. And there are fixed income bonds, sometimes subordinate debt. All forms of debt instruments are in play when it comes to mostly in non-banking financial companies. And I think it's quite sizable amount of capital out there. Do you think at some point this will get replaced by, at least large chunk of it will get replaced by private credit funds stepping in? Because if I were to reflect on how these funds are mobilized by the operating companies like the NBFCs, they have to deal with a lot of large number of retail investors, and then then one side sourcing the fund, another side deploying it effectively again at the retail market. You think there is an opportunity for consolidation at some point in time, or perhaps replacing that bit? Because we've also seen a lot of regulatory nightmares with respect to how this is managed. There's a lot of concerns from regulator standpoint in terms of how NCD as a source and subordinate debt as a source is being used by some of the large financial services players.
So, I'm not sure necessarily there'll be a replacement. I do think, as I said, banks have, play a certain role in the economy, in provision of certain kind of capital. I think NBFCs again play, a pretty important role sometimes in that last mile, sort of reach when it comes to finance, when it comes to financing certain asset types. And then private credit funds also have a certain role to play. I think the basic funding model is very different, right? Very simplistically perhaps, but at the level of banks, you're looking to maximize your depositor money and lend against that, right? That gives you a certain risk profile that you want to lend against, and a certain profile of loan book books you want to create. I think increasingly, if you look at the banking sector and actually even NBFCs and loans from banking sector, you can see that the percentage of retail loans has actually significantly risen, whereas the percentage of manufacturing and service sector loans has come down. The NBFC model sits somewhere in between. It does not have depositor money directly, but it's a big part of its liability side really comes from banks.
Yes.
For us, unless you're a sort of a AA NBFC, then you can tap into some of the insurance and mutual funds. But otherwise, the liability side comes largely from banks. And that then also, has an implication of what kind of asset book you want to run. And rightfully so, RBI, is concerned about that, or, always has an eye on that. I think more importantly, as a business model, it's a leveraged balance sheet that's then making asset plays, right? That's lending to assets, which means at the end of the day, anybody who's providing leverage is going to want to see very predictable, asset performance, loss ratios, because you lend on the basis of that. You take a debt position based on that.
Yeah.
If you look at private credit funds, category 2 funds, right, as SEBI sort of classifies, which is where most private credit funds are, there is no leverage, right? So it's sort of lend dollar for dollar in terms of the capital that is raised and the investments we make in various companies. So the thought process in terms of how we look at portfolio construction, how we look at, creating assets is a little bit different. Right? I think NBFCs in some ways operate far more granular books than we do, but that's also because, they're taking on some leverage on their balance sheet. I think our portfolios will look similar to private equity portfolios, slightly more. So for instance, we aim to make 25 or 30 investments. We're not making 1,000 investments, but then every investment is structured in a way to, so that we're not looking at a realized loss from any investment. So the lending models are very different. And I don't necessarily see it as one replacing the other. I think as our markets grow, every one of them will fall into the sort of right, end use that particular model addresses.
When you look at India's market dynamics, you've also mentioned about how family offices are a primary source of a large source of the capital that you raise, and also the mid market. If you look at largely driven by promoter driven sort of market, playing, most of them are not necessarily having a lot of credit history, but very healthy by forms of traditional funding, whichever way they've handled it. But one aspect of not having so much of contractual compliance, right, in terms of documentation wise, not being there in terms of, you don't pay attention to the fine print many a time. People just, I can't make a sweeping statement like this, but generally we don't read too much in those documents where we sign, right? That is in somewhere there, it's also a habit over a period of time by seeing this bunch of papers that is shown to you as part of a loan agreement. But then in terms of private credit operations, it's very important that one understands the terms, the clauses, and also how you operationalize this, right? In your experience, can you tell us how good is the contract compliance, documentation, and generally adherence of terms that you put across ESG, for example, which is more measurable in that sense, and you can see the steps that are taken and in a way, more monitorable. How about the other terms and conditions that goes along with execution of a deal in comparison with other matured market? How is it in India? And are there areas where significant improvements are immediately needed?
Yeah. So, I think my team, and I would say that I think promoters and business owners read through the document and they negotiate hard, right? So I think, it's at the consumer level, when you and I go and take a loan on, on a car or on a house, yes, we sign, sort of a pre-printed application form. But I think on sort of private credit and loan documents, promoters read through everything. I think, there's a great understanding of what they're signing up to. The important part there is the covenants, for instance, right? I think for us, a big part of what we do in the 8-12 weeks of doing our due diligence and sort of moving ahead on the transaction is explaining to the business owners that these covenants are something that are going to be tested, monitored on a regular basis. And if there is a breach and there's penal interest implication or default interest implication, all of that is going to be, we're going to be applying it. There's no waiver on that. So it's something that they should be strictly adhering to. So the business plan covenants, is something that is thoroughly discussed with some, agreed cushions built in, and only then those are sort of put in place. So that's a question of managing those expectations, that these covenants are not just going in now and then we all forget about it, that we actually look at this very closely. And I think there is a, sort of growing recognition amongst, promoters. In fact, one of the things that I always say to a lot of, especially the international investors, that, we are dealing with companies that are anything from 1,000 to say 3,000-4,000 crores in terms of top line, right? At that kind of size, you have a company that's around 20-25 years and actually pretty sophisticated, in their own ecosystem, probably a market leader in their product or geography. And a lot of times when you think of these companies in dollar terms, I always feel that we underestimate the market presence. When we think of mid-market, these are not unbanked companies by any, means. They are companies with banking lines, track records for a long period of time. So I think documentation and respecting the covenants or working with the documentation is something, in our view, we manage during the process. And then thereafter, we've seen, pretty good compliance with that. On the ESAP plan also, yes, sometimes, you may have a company that falls behind on a particular milestone. But then we sort of take it upon ourselves to be a bit more proactive and, figure out what the issue is and help them sort of bring them to compliance.
Is there anything more the regulator is going to be, expected to do? Any ask from perspective of, policy or regulatory level changes that would help private credit funds to grow further and get to the potential that they have here in India?
See, I think it's an evolving process, right? We all talk about the insolvency code, and that's been a big game changer, right? In on the credit side, a lesser sort of talked about feature, which I think has really enabled the development of private credit in India, has been, presence of credit bureaus. Compared to, let's say, some of the other countries in our region, I think India's had credit bureaus for now 20 plus years with pretty good penetration, rising penetration every year. Between RBI setting up, CRIL, and which needs all the large exposure reporting and SMA reporting. I think that's been one of the key things that have changed borrow behavior almost, right? You sort of know if you can no longer have overdues with one bank and then try and raise money from elsewhere.
Yeah,
right?
that's not possible.
And I think that's fundamentally changed borrower behavior. So it's 2-3 things other than insolvency code have really helped in sort of development of credit markets. Yes, a lot can be done. I think even insolvency code, we talk about, how it could get better, the time can come down, etc. But I think I also recognize sometimes the size of challenge that, lies in front of us. But, a simple thing, for instance, Surface today is available only for listed bonds. Whereas you're a bond holder, right? It should be available whether you're listed or not, right?
Yeah.
And whatever measures need to be in place so that it can then be extended to all debt holders would be a great sort of thing to have. AIF, right? Our AIF regulations and the ability to, raise sort of private credit directly under these AIF formats, again, has been a big sort of step in the right direction. But the next step on this can be innovation, right? So for instance, you have a, whole lot of investors that see this massive opportunity in an economy like ours, where there's growth, there's, good sort of reforms, banking sector is, large and stable now. But I think different investors will have very different requirements of where they want to be in the risk return spectrum. Right. So we target certain kinds of companies and say generate 15% returns or 16% returns. There would be investors who would say, I like the India opportunity. I like this. I want to do private credit, but I would like a little bit more protection. I'm happy with 300 points less return. As an example.
Yeah.
One innovation that we've seen in markets is tranching the capital structure, right? There are investors who are happier to be in the lower return, lower risk, but want exposure to that asset class.
Yeah.
Whereas there are investors who would say, I like this asset class, but I would like a little bit more return. I wouldn't mind, being, say, junior in the structure. So tranching as a mechanism, and obviously it needs, regulatory side rails to make sure that it's done the right way. But then as an innovation, I think it's a great thing that the AIF industry can have. And, that's under discussion with the regulator, and hopefully we'll see, a way of moving forward with that. So I think there's, it's an evolving process, and as we go along, bringing in some of these things will help the industry develop further.
So from a India focus standpoint, you talked about mid-market and you talked about the performing assets that focus. Can you give us some more detail about any specific sector that your previous investments were more the co-working space and also the real estate infra sort of sectors? Do you have a visibility that you can share with us in terms of which are the top sectors or subsectors that BPEA is going to look at from India's growth perspective?
See, fundamentally, our strategy is sector agnostic, right? We, our whole approach is to find, but the way we look at our companies is we think about the returns we are making in terms of an illiquidity premium that the investors are earning, because a certain end use or a certain requirement cannot be met through regular sort of banking channels, right? We fundamentally need companies that have very high incremental ROCs to then consider paying this, additional sort of cost to sort of capture that growth, right? So for us, when we therefore look at sectors, it's more to think about sectors where we believe the growth prospects are very strong and where, we see less volatility, right? So in some ways, we always say that we're not looking for a 3 times return. but we want a 15% return with, with a very, very high sort of confidence level. So for us, the sectors, then depending on the vintage of the fund, sectors is about, what we see in the macro at that point in time. So for instance, right now, we're seeing a lot of opportunities arising out of all of the infrastructure work that's happening in the country. And it's not so much greenfield infra.
Yeah.
Right? But it's EPC companies that are benefiting from, big order books, right? We're looking at oil and gas pipeline laying business, a lot of work happening there, needs to happen. Again, companies that are, in that sector. Co-working, sort of you talked about, a lot of work around logistics, warehousing. But not just that, I think even the manufacturing and service sectors, there are acquisition opportunities that companies are seeing. There are opportunities arising out of, supply chain, call it supply chain diversification or supply chain resilience that a lot of people are, looking for, and companies benefiting for that. So we're seeing a lot of these opportunities coming from there. So in that sense, it's still very much sector agnostic. I would say the sector that we are a little bit staying away from right now or feel unsure about is the consumption sector, by and large. We still think that there could be some issues. It may take some time before it really picks up, or we may just see a lot more volatility there.
Yeah.
And in that sense, we don't see that as being very suitable for a debt strategy. You may still
for some reason, I'm sorry to interrupt, but for some reason, that's one sector where we have seen least of startup disruption as well. Everywhere else, a lot of startups and innovations coming in. Sorry, continue. I was just...
No, I think you're right. But I think in some ways, it's also to do with everything that we've gone through as a part of the pandemic, right? I mean, there has been a big change even in employment numbers, and not just in terms of absolute employment numbers, but in terms of composition of employment. We've seen sort of jobs going back into rural, agri a little bit more. Within the services sector, and I was looking at this report, which was, from a few months back, within the services sector, the job increase has happened in more personal services, as opposed to business services, right? Where the sort of per capita earning is lower than that, right? So all of this in some ways has impacted the consumption power or the purchasing power. And I think we are seeing that reflected.
That's true. That's true. So, we are almost about to conclude, but before we go, can you tell us about the plans for new funds, anything in pipeline that are going to be launched?
No, so we just closed our, Fund 3 middle of last year. So we are right now very busy deploying that. There is a, pretty strong pipeline. Obviously there aren't any immediate plans for the next fundraise. Let's see, maybe sometime next year would be a good time to think about that.
Give us a sense of the fund that you plan to allocate for assets in India.
So in fact, the fund 3 that we've raised, which was close to $500 million, is focused 100% on India.
100% on India. Okay, excellent. Good. I think it's been a great session, and thank you for sharing all these insights, Kanchan. Always a pleasure to have you here.